Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. We are going to talk about Heikin-Ashi candlesticks because what I noticed is when you're looking at some of these international ETFs, especially those trading in Asia, they got all these gaps and kind of noise, it seems, and you can kind of smooth it out by taking an average of the last two candlesticks by using the Heikin-Ashi candlesticks. So I'm going to show you how those work, and we're going to look at some examples using the Japan ETF, of course, and I've got some Chinese ETFs that I want to show you that are setting up with pullbacks within their bigger uptrends. Let's take a look. So this first chart here shows the Japan ETF, EWJ, and I think if I'm going to talk about candlesticks and Heikin-Ashi candlesticks, I better start with Japan because that, of course, is where candlesticks originated. So if we look at this chart here, we can see it's very gappy. You know, you've got a lot of gaps on the open, and you've got some days where you gapped up on the open and you didn't move much after the open. Of course, on some days you did move down after the open here with that long black candlestick, but you can see you get these big gaps up and not much movement. So it's very gappy. And the total reason for that is because, you know, Asian trading has started long before the U.S. markets are open, and it's ending when the U.S. markets are open. And so all of the Asian price action has already taken place pretty much by the time the U.S. markets open. And so the U.S. markets are just reacting to what has happened in Asia. Now, of course, there can be some action in the U.S. that is going to affect Asia. And so you'll see some days here, like you can see you had an open here, and then you had a decline after the open. So there was some U.S. price action that was going to be carried on and affected later on in Asia. But the reason you get this gappy action is because the trading in Asia has already taken place and the U.S. is just reacting. And so I was looking at this chart here and I was thinking, what can I do to make it smoother? Because I don't like the gappiness. It's hard to get your patterns working and such. And so there's an alternative called the Heikin-Ashi candlestick. And I'll just show you what that chart looks like next. So here is the Japanese ETF with the Heikin-Ashi candlesticks, and you can see miraculously all these gaps disappeared. And that is because this is an average of basically two candlesticks. And if you want to know more about this, you can always go over to the chart school, which we're going to do right now. So anything that you're charting on stockcharts.com, you can learn about in the chart school, and there is a link to the chart school at the top of every web page. And here I am on that chart school page, and you can scroll down and you can look for, it's going to be in chart analysis, whole bunch of stuff there to keep you busy learning and improving. Now you can just type in a term here to search. So I'm going to just type in Heikin to search, and there we've got Heikin-Ashi candlesticks in the chart school. And so we look here, we can see how it's calculated. Heikin-Ashi means average in Japanese. And so you've got a close, and it's the average price for the current day. So the average between the open, high, low, and close. And then the open is the average between the open and close of the previous day. So it's the open plus the close of the previous day divided by 2. And then you can see the Heikin-Ashi high is the maximum of the high, open, or close of the current day, which is basically the high. And the Heikin-Ashi low is the low of the current day, which is basically the low. And so that's why it is an average and why it removes those gaps. And I think you can find it easier to draw patterns, and it smooths out the noise a little bit that you might seem to think you're getting when you're looking at a candlestick chart for ETFs that's traded. Basically, the underlying components are traded in Asia, And so it's reacting to that trading by the time the US opens. So here's a chart that shows them one on top of the other. We've got the Heikin-Ashi candlesticks in the top window, and then we've got the normal candlesticks in the lower window. And this is still the Japan ETF EWJ. And you can see the same patterns are there. You know, you have this consolidation here and a breakout, and we had a consolidation here and a breakout as well. And now we've got this pullback here, and this is pullback that I want to focus on. So looking at this chart here, this is again EWJ. The long-term trend is up. There's the 200-day, and we've been above it since August there. And you can see the 200-day started turning up in November, and that's when we got this big breakout here. Look at that big surge and break above that resistance zone from September and October. So we had this massive move, and we were pretty extended here in February up around 72. And so we got a correction, and this correction looks like it's ending. Now, the thing about corrections, as I said before, it's kind of like a box of chocolates. You never know what you're going to get. Are we going to just get a pullback? And you can draw your trend lines here, and you can see this is some sort of a channel, and we're breaking out of it. And you can see we're bouncing off support, and this decline retraced around 38%. So a falling channel that retraces a little over 2/3 is pretty normal for a correction, and looks like we're breaking out and continuing higher. Now, if you go to your Elliott Wave book, you'll see that corrections can sometimes form this ABC zigzag type thing. But as long as we're moving higher here, we don't see that zigzag happening. But if we start breaking down, getting back below, say, 68 there, then maybe we have this ABC. So there's A, there's B, and there would be C coming into to maybe that 60, 65 area for support. But right now, the base case is that we are bouncing and continuing higher because the trend is up. You can see RSI was in that oversold zone, in that 30 to 50 zone. And then we got the Stoke RSI pop there about a week ago. And that's kind of like the early signal that you're getting a momentum pop that could signal a reversal after a pullback. And so the setup is, first, you're in an uptrend. Second, you've got a pullback. Third, you've got RSI in the oversold zone. So once you have those three things in play, then you look for the stochastic pop and Stoke RSI pop. And when it pops above 0.80, that tells you you've had some sort of momentum pop, so to speak, that can signal the start of a renewed push higher. And so we've gotten that. And as I showed before, we've got that channel break working here. So Japan's looking bullish. Now, I was looking at the Chinese-related ETFs, and I noticed they all pretty much have the same pattern working here. And this is FXI, the China Large Cap ETF. And, you know, it had this big move up from late December to a new high there in mid-February, and then came down pretty hard. But it does look like a correction within a bigger uptrend. You can see this was a correction here. I've got Heikin-Ashi candlesticks on here as well. So this is a long correction, and then you got the breakout. This was a short one, and you got the breakout. And this one's a little bit longer. But the point is, it looks like a pullback is always considered a correction within the bigger uptrend as long as the bigger trend is up. And we're above that rising 200-day moving average. We hit a new high about a month ago. So the long-term evidence is clearly bullish here. And what I'm noticing here is you've had this pretty sharp decline. You had that big down day. Now, this is the Heikin-Ashi down day, so it might be a little bit exaggerated there. But then you've got a lot of consolidation here, except for this white candle. You've got basically 5 days of nothing, a very tight range. And so it's winding up and getting ready for a move. And you've got this resistance level established from that pullback last week. So you had a pop, and then you had a pretty sharp decline on Friday. And I think there was some news that the Chinese government, the regulators, were cracking down on some of the big tech giants there and consumer giants there that have a monopoly. Tencent was specifically mentioned, and they got hit pretty hard. But it's still a correction, and if we can get a breakout there, I think that's going to be bullish for China. And if we look at the RSI, Stochk RSI strategy there, you can see RSI was oversold, it still is. And then we got the Stochk RSI pop last week. It hasn't fallen, we haven't gotten follow through on the price chart, and that's what we're looking for next. So I've got 3 more Chinese related ETFs, and you're not going to get any diversification out of these. If you're basically thinking you're getting diversification in China by buying these 4 ETFs, well, they're very highly correlated. So you're not getting any diversification benefit. And I would suggest you look elsewhere if you want diversification. If we see here, we can see this is the China smaller cap ETF, the 300 China A-shares ETF. And it's got this pretty sharp pullback, but it's coming into a previous consolidation with that, which acts as support. And you can see consolidating, and we need to get a break above that high there to end this little consolidation and signal an upturn to be bullish. And then the next one we're going to look at would be the Internet ETF, KWEB, from Crane Shares. And the same exact pattern working here. Big surge to new highs, a pullback, and then a consolidation. And there's that high from last Friday. And we need to break above that to get the bulls going here. And then finally, we have the China Consumer ETF, CQQQ, and it actually looks a little bit weaker than the other ones, but the same pattern pretty much. You can see this consolidation previously, so we're holding above it, and we've had a pretty hard correction, firming again, and we need to get a breakout there to reverse it. So if you're interested in knowing more about our services, check out trendinvestorpro.com. This is the main analysis page, and it shows all the latest commentary. I have a current market regime link where I'm keeping track of whether we're in a bull or bear market, and I've got a ranking trends and setups table for 119 ETFs. And then you can see the latest commentary. We're talking about growth ETFs and corrections, the Heikin-Ashi, which we're talking about today, and I've got 7 international ETFs setting up, as well as healthcare. And then you can see there's the market regime and the ranking table. And I've also got a weekend video that covers everything to keep you up to speed for the coming week. So please give it a try if you're interested. And real quickly, I've got one more that's setting up similarly, and this correction is not as deep, and it is the South Korea ETF. So you can see where the Chinese ETFs corrected pretty hard. The South Korea ETF corrected fairly mildly and looks like it's trying to turn up, and so a breakout there would be bullish. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.